Jim, want to break down the bank earnings, JP Morgan, Citi, Wells. What was your number one takeaway out of the three?
Okay, this is a really bad group because this market is focused on revenue growth because everyone's concerned about a slowdown worldwide. So if you don't have good revenue growth, then they're not going to look at all these different one-time things that manage to give you earnings per share. I mean, one of the reason why revenue growth is a natural place to gravitate to, and Citi had a little bit quarter to quarter and Wells had a little degradation quarter to quarter, is because when you look at the actual makeup of the earnings, it's almost impossible to discern where the earnings really are, or how much of it is from one time, how much of it is from a change in the value of different instruments held, how much of it is a actual loan loss reverse. So, you know, you can't get in front of the group if Europe doesn't change because people feel they have exposure, even though we know that they've cut their big money fund exposure. And I remain a huge believer that you can't own this group until we see the vast capitulation from a Paulson, from a Berkowitz, and we see revenue growth. And we just don't have it.
And was it any positive that perhaps they released some reserves that were more than expected? I mean,
No.
or do those things not really count anymore?
No, without a national mortgage deal, then we're just going to continue to be plagued with this. Fannie and Freddie have not been able to harness the low rates that Bernanke has caused, and the banks themselves are still being under assault from all sides, including anytime they raise their fees. So I think you've got a situation where you just have an asset class, you have a sector that is just not ownable. It's okay, it's happened before.
And it's going to be even worse for like a Goldman and a Bank of America tomorrow?
Look, Bank of America, the expectations are now so low that I'm not sure what it'll do. But the litigation expense there is well off the charts.
Maybe it's a reason why the expectations are so low and it matters.
And Bank of America needs a mortgage agreement. Bank of America is very poorly run. Very poorly run.
And Goldman?
I think that Goldman will probably, people are looking for a loss. I think Goldman is going to announce some structural changes in compensation that could help. Morgan Stanley, I think, probably has the best number because Morgan Stanley is reacting to an endless attack by a website. I'm not going to mention the website because all it does is boost their sales. And I just think it's just not, if the stuff were accurate, I think I would say you have to reference it. But Gorman needs to keep his job, and that means he has to deliver a good quarter.
Right, okay. And if you do happen to own these banks, even though you've said not to, what do you do now? You have to sit with them for a while?
We own Bank of America fractional reserves. It's the worst stock we've ever owned. And you could say, well, why did you not sell it all? We sold half. And the answer is because we get things wrong. I mean, we got caught up in restrictions, but we get things wrong. USB is probably the best because it seems to have more momentum than Wells Fargo. It'll be interesting to see what Wells Fargo has to do with investment banking. But look, this is, I come back to the fact that this is a very hard group to own.
Hard group to own. All right, thanks, Jim. For more of Jim's stocks picks, you can go to cramerspicks.com.